The markets held up most of the day, but near the close, they started selling off. The Dow was up, I think, over 100 points at one point today, but finished down 52. The overall analysis, though, is that it's trying to form a J-hook pattern. If a J-hook pattern starts confirming, meaning wave 3 being the same magnitude as wave 1, that would demonstrate that this recent high of the markets is going to be breached and we're moving into much higher territory. The same analysis can be applied to the NASDAQ that actually stayed up positive a little bit today, but notice the shooting star type signal. We're still above the T line, so it will be important to see how the markets open tomorrow, and the fact that they are trading above the T line. You don't want to see any close below the T line. That would negate the strength of this uptrend. Numerous J-hook patterns could be identified by simple identification of signals occurring right at the T line. Our recommendation on Brooks Automation was based upon a J-hook pattern and now trying to break out to the upside. Also creating a wave 1, wave 2, wave 3 upside potential. The upside expectation is that we're heading higher. The stop loss is very simple. We don't want to see it close back below this level because that would negate the pattern trajectory. DOCU was also a recommendation based upon the potential of a J-hook pattern breakout. Wave 1, wave 2 going into wave 3. Once again, knowing where to enter a trade and where to get back out of a bad trade is much more easily identified using candlestick analysis. For example, positive trading from here, doing a doji sandwich breakout through this level would be a good indication we're in wave 3. A lower open would have kept us or would keep us out of this trade because it didn't break out. Or if you bought on positive trading today, you know that if it opens lower, and especially if it trades back below the low of today, you want to close out the position because the J-hook pattern did not work. The fry pan bottom also provides an expected trajectory. If bought on positive trading today, as long as it stays above the T line, the fry pan bottom has a very simple rule. As long as the trajectory stays above the T line, you can stay long. Or if you didn't enter the trade today, if it comes back up through today's open, that's pretty much confirming that this fry pan bottom breakout is still in progress. Knowing where to start looking for buy signals puts the candlestick investor to a great advantage of knowing which pattern situations have the highest upside potential. For example, a bullish Harami right smack dab on the 50, when it gapped up the next day through the T line, it still made the prospects with the strength of that gap up after a bullish Harami that if they broke out through this level, that we are now in another wave to the upside. That was additionally confirmed today based upon a big price move, a doji, and a doji sandwich trading positive today with a high prospect of another big day with the doji sandwiched in between. That same scenario can be applied to SEDG, S-E-D-G, a bullish Harami followed by confirmation, and look where the bullish Harami occurred, right smack dab off the 50 with stochastics coming up. If it broke through this level, we are in wave 3, and what confirmed the buying today? Again, another doji sandwich, and what implications do we have coming from a doji sandwich? There's going to be more upside. Knowing these simple rules based upon what human nature does time after time allows the candlestick investor to take advantage of knowing where the high probability entry points are and what patterns are going to create the most profits. That'll be it. We'll see you in the chat rooms.